For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Investors often search for entry points that align with strong fundamentals and long-term growth narratives, and according to analysts, there is a specific price range where buying Palantir shares could offer a favorable risk-reward trade-off. What makes this company particularly compelling right now are its continued advancements in artificial intelligence software, increasing traction with government entities, and an upward revision in its fair value assessment. Contribution margins, which measure operational efficiency, reached an all-time record of 61%. Revenue increased by 39%, and the adjusted operating margin hit 44%, both highly impressive figures that underscore Palantir's growing scalability and profitability. Additionally, the company continues to gain momentum across its dual focus areas: the United States government sector and its expanding commercial customer base. Despite these solid results, market sentiment suggests that even strong earnings reports and upgraded outlooks may no longer be enough to catalyze significant stock price increases. This signals a shift in investor expectations, where exceptional performance is now being viewed as the baseline rather than the exception. Part of the reason for this tempered reaction lies in Palantir's current valuation. The stock trades at 73 times its revenue, a figure that represents nearly a 400% premium when compared to other companies in the artificial intelligence software space. Such a high multiple sets a demanding bar for future performance. For example, a recent 4% increase in Palantir's projected revenue was perceived as underwhelming, even though it would be considered a positive revision for most other firms. However, there is a strong case to be made that Palantir warrants this premium valuation. In the United States alone, the number of commercial customers rose by 65% year over year. Moreover, not only is the customer count expanding, but the average deal size is also increasing. The company has seen a doubling in the number of agreements valued at over $1 million, which speaks to the deepening trust and reliance customers are placing on its platform. These positive developments have prompted analysts to maintain their narrow moat rating for Palantir, indicating a competitive advantage built on barriers such as customer stickiness and intangible assets. Additionally, the fair value estimate has been revised upward by 11% to $100 per share, reflecting rising demand from both government agencies and commercial enterprises for Palantir's data-driven optimization tools. These include the ongoing initiatives from the Department of Government Efficiency, the development and potential expansion of the Golden Dome missile defense system in the United States, and the possibility of a national security budget that could exceed $1 trillion. Each of these elements provides structural tailwinds that could support sustained demand for Palantir services in the years to come. From a valuation standpoint, the company currently resides within what analysts classify as a 3-star territory. This rating indicates that the stock offers a balanced risk-adjusted return when compared to long-term expectations. Should the stock retreat to the $80 price level, many analysts believe it would create a compelling opportunity to accumulate shares. Palantir is also outperforming traditional benchmarks used to evaluate software companies. For example, the Rule of 40 states that a combined score of over 40 derived by summing revenue growth and operating margin signifies strong performance. Palantir's score of 83 highlights an exceptional combination of growth and efficiency that few firms can match. Considering its 3-star rating and fair value estimate of $100 per share, which implies an enterprise value to sales ratio of 57 times by 2025, Palantir may still be reasonably priced for long-term investors. If the stock declines to the $100 mark again, that could be seen as a prudent moment to increase exposure. One of the most critical factors influencing Palantir's valuation is the scope of its total addressable market, or TAM. This term refers to the complete revenue opportunity available for the company's products and services. The sheer size of this market opportunity is a pivotal component of the investment thesis. Analysts have modeled a base case scenario in which Palantir's TAM reaches $1.4 trillion by the year 2033. Importantly, the expected growth is not projected to be linear. Instead, there is a forecasted inflection point occurring between the years 2028 and 2030, during which annual growth could accelerate to approximately 35%. These projections suggest that Palantir is still in the early stages of benefiting from a major technological transformation. If this trend follows a similar pattern to prior technological revolutions, such as the cloud computing boom. Palantir may well mirror the trajectory of software pioneers like Salesforce in the late 2010s. Salesforce became known for streamlining enterprise sales processes and integrating disparate systems through automation. Palantir is now doing something comparable, but at a much larger scale, focusing on optimizing decision-making processes across entire organizations through the power of real-time data analytics and artificial intelligence. The company's competitive advantage lies in its ability to unify disconnected datasets into a single operational framework. Unlike many of its competitors such as Amazon Web Services, Snowflake, and ServiceNow, Palantir provides not only the tools to analyze data, but also the architectural structure to connect insights across departments. Its software operates using a read-write feedback loop, which allows the system to continually improve its insights based on new inputs. This innovation makes Palantir's platform particularly valuable for organizations looking to scale efficiently while making highly informed decisions. One of the main competitors Palantir faces is not another firm, but rather the traditional information technology departments found within large enterprises. These in-house solutions often rely on patchwork systems that are difficult to update, expensive to maintain, and limited in scope. In contrast, Palantir's unified system allows businesses to create sophisticated dashboards, run simulations, and develop predictive models, all within a secure and scalable infrastructure. On the financial front, Palantir's position is strong and appears to be getting even better. As of March, the company reported nearly $1 billion in cash, along with $4.4 billion in marketable securities, primarily in the form of United States Treasury instruments. With zero debt on the balance sheet, Palantir's liquidity position improved by $1.5 billion during the year 2024. Profitability is also moving in the right direction. Palantir has now recorded 2 consecutive years of profitability based on generally accepted accounting principles. In 2024, the firm's earnings more than doubled compared to the prior year. This surge in profitability demonstrates that Palantir's business model is not only scalable but also increasingly efficient. While there have been historical concerns about dilution due to high levels of stock-based compensation, a recent one-time expense of $120 million in the fourth quarter of 2024 was triggered by the stock price surpassing $50 per share. However, this is not expected to be a recurring event. Despite these strengths, Palantir is assigned a very high uncertainty rating. The primary reason for this classification lies in the unpredictability of how large its total addressable market could actually become and how deeply it can penetrate that market. The company's flexibility and versatility provide a great deal of upside, but also introduce risk. When investor expectations around the size of the TAM shift negatively, the stock can experience sharp downward corrections. Essentially, Palantir Technologies continues to demonstrate strong growth in artificial intelligence software, with rising government and commercial demand driving an 11% increase in its fair value estimate to $100 per share. Despite reporting record high contribution margins of 61%, revenue growth of 39%, and adjusted operating margins of 44%, its stock dipped 9% due to high expectations created by its premium valuation. Analysts view the stock as fairly valued and suggest accumulating shares if it drops to the $80 range. With a rapidly expanding customer base, a growing number of million-dollar deals, and a projected total addressable market of $1.4 trillion, by 2033, Palantir is seen as a key player in the ongoing artificial intelligence revolution. Its strong balance sheet, growing profitability, and unique data integration capabilities position it for long-term success, though uncertainty remains around market size and adoption rates. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.